Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Daybreak Asia podcast. I'm Doug Krisner. Today, President Trump said the U.S. is in a trade war with China. Earlier in the day, Treasury Secretary Scott Bessent proposed extending the pause on increased U.S. tariffs on those Chinese goods. Bessent said it would be done in exchange for Beijing putting off its recently announced plan to tighten limits on rare earth elements and the exportation of those out of China. Now, these minerals are critical to many industries, as we know. Here is Treasury Secretary Bessent.
Right now, we are currently in a 90-day roll on the tariffs. So is it possible that we could go to a longer roll in return for a delay? Perhaps. But all that's going to be negotiated in the coming weeks.
Now, this week in Washington, G7 finance ministers will consider a joint response to discourage Beijing's planned move to control those rare earth minerals. And the timing is interesting, too, because next week, Australian Prime Minister Anthony Albanese is set to meet with President Trump in Washington. Perhaps the most important topic is critical minerals. For a closer look now, I'm joined by Bloomberg's Paul Allen, who is in Sydney. Paul, thanks for making time. You and I have talked in the past about Australia's vast supply of rare earths. So if you had to kind of gauge what a deal between the U.S. and Australia would look like in terms of rare earth minerals, give me a sense of what that might look like.
Well, there's certainly a lot of speculation around this, Doug, the prospect of a deal around critical minerals, because we've heard President Trump talking in the past about ideas like, well, maybe we could take over Greenland or involvement in Ukraine. And at the core of a lot of these statements is these countries' and nations' critical mineral reserves. And Australia, depending on how you slice and dice it, has either the largest or the second largest critical minerals deposits in the world. But the limitation here is the refining of those deposits. Australia's got the mines. It certainly has the scope for plenty more critical minerals mines. But all of the processing happens offshore, mostly in China. Some of it happens in Korea as well. So any discussion around a potential deal likely to focus in on how these minerals get processed. And there's been some speculation in the media that there could be some sort of deal with the US in the range of $700 to $800 million. But beyond that, we don't know anything. The government's been very tight-lipped about this, which again leads to future speculation that we very well could see something get announced when Anthony Albanese meets President Trump.
So what's holding Canberra from building up refining capacity in Australia when it comes to the processing of these rare earths?
Well, certainly the political will exists. I think the question is more a commercial one. I can give you an example of one company. It's a small company called Australian Strategic Minerals. It's seen a very healthy run-up in its stock price on the ASX. This is despite the fact that it doesn't actually have a mine in Australia. For as long as I can remember working for Bloomberg in Australia, ASM has been talking about starting a mine in near a town called Dubbo in New South Wales. It's still about to start its pre-feasibility stage, so it's taking a long time. There's certainly a desire to get this done, but critical minerals processing, very energy intensive. It generates a lot of toxic waste as well. So putting together these things seems to be the major hiccup. The biggest critical minerals miner listed on the ASX is Lynas. But it does all of its refining in Malaysia, for example, but it does have a mine here in Australia. So it does speak to this broader problem of the cost, the pollution, the regulation of getting processing underway in Australia.
So how have these stocks and these Australian mining companies been performing lately? Have they been advancing?
Yes, they have been advancing. I can't give you too many details on the movements today because they're also volatile. They do shift around a lot, but the overwhelming theme has been one of optimism, a sense of opportunity for Australian critical minerals miners, and some of the big players are involved in it as well. Rio Tinto is a major miner of critical minerals. So is South 32, which was spun out of BHP some time ago. There's another company called Aukus as well. They've all seen healthy rallies in their stock price inspired by this need for critical minerals. But as I say, this issue's been around for probably a decade or more, the need to diversify where these come from. It seems getting that diversification to happen, that's the difficult part.
So I mentioned a moment ago that President Trump was saying earlier that the U.S. is in fact in a trade war with China. How is this being viewed in Australia right now, the tension between Washington and Beijing?
It has forever been a very, very difficult tightrope for Australia to walk because on the one hand, China is Australia's largest trade partner by some considerable distance, and it was not that long ago when Scott Morrison was Prime Minister that the country was reeling under trade strikes from China for all sorts of things, from coal to wine to barley. And when the new government got elected here 4 years ago, the Albanese government, that was seen as something of a reset, and those trade strikes have since been wound back and the relationships improved again. But it's well known that China is no fan of the Aukus agreement between the United States and the United Kingdom. The United States is Australia's most important ally. The relationship there is very, very close as well on a diplomatic level. We heard from the Deputy Prime Minister Richard Marles saying that no country is closer to the US than Australia in terms of how we engage and the level of trust that is there. So navigating that tightrope, particularly when your closest ally is saying it's in a trade war with your closest trading partner, it's a really difficult foreign policy balancing act.
So I know you talk daily about the weakness of the Chinese economy, and I'm curious about the current trade relation right now between Australia and China and the degree to which Australia's exports, particularly of things like iron ore, have been kind of stymied a bit by some of the struggles that China is enduring right now.
Yeah, somewhat. Life has not been as great for Australia's big miners as it has been in the past. And, even though I mentioned those trade strikes have been wound back, we still see evidence of tension bubbling up from time to time. BHP, the world's biggest miner, for example, that's one of the biggest, often, depending on the fluctuations in market cap, the biggest listed company on the ASX at the moment, having difficulty getting its iron ore into China over a pricing dispute. So that's still getting ironed out. But we had another listed company, Treasury Wine Estates, announcing not that long ago, a few days ago, that it was abandoning its 2026 guidance against the backdrop of this tension. Its two biggest markets are the United States and China. They're in a trade war, in the words of President Trump at the moment. So Treasury Wine Estates said, look, we can't give reliable guidance at the moment. And we saw the stock price falling 11% this week. And over the course of this year, its values dropped by about half. And if you're going to point the finger of blame, what caused this, the catalyst, it's that trade tension.
Paul, we'll leave it there. Thank you so very much. Bloomberg's Paul Allen in Sydney joining us here on the Daybreak Asia podcast. Welcome to the Daybreak Asia podcast. I'm Doug Krisner. In the U.S., the equity market closed mostly higher in the last session, given upbeat signs on the American economy. Factory activity in New York State unexpectedly expanded, and at the same time, Bank of America reported third quarter earnings and revenue above expectations. For a closer look now at the U.S. price action, I'm joined by Keith Buchanan. He is Senior Portfolio Manager at Globalt. Keith is on the line from Atlanta, Georgia. Keith, thank you so much. Can we begin by kind of summarizing what you heard from the big banks? Some record-breaking numbers for the fourth quarter. Obviously, a lot of deal activity. Trading revenue was very strong as well. What's your takeaway?
Sure, and thanks again for having me, Doug. Our biggest takeaway thus far this earnings season when it comes to larger money center banks is, things are really just chugging along at a pace that honestly we feel like it's been somewhat not appreciated on a larger scale of what the market's focused on. I think the lack of data from the government from a macroeconomic standpoint possibly could kind of clear the way for some of the read-throughs from the larger banks to really hit home with the marketplace. And they're really hammering home the fact that the macroeconomic environment is really growing at a clip that really doesn't vibe with what some of the negative rhetoric we've seen in the labor market particularly, but also the consumer environment and what they've seen as far as the consumer behavior and the lack of deterioration on the consumer's part in a way that also vibes with the jobs reports that we've seen recently, really has us focus on the spending that the economy needs at this moment, and the consumer is pitching in its more than its fair share.
So tomorrow we'll begin hearing from some of the regional banks, and a few analysts were saying today, if there is trouble ahead beyond the shutdown or beyond U.S.-China trade tensions, the regionals really are the place to look. I thought it was interesting today that the KBW Regional Bank Index was down about 2.3%. How do you feel about the regional banks right now?
Sure. In the larger scale, the larger money center banks have more levers to pull in order to drive earnings growth, just in the general sense. And the regionals are more dependent on just net interest income and the drivers of loan growth and being able to make that spread of lending on the long end and borrowing on the short end. So that the pure banking aspect of how banks have traditionally made earnings is more, kind of at focus with the larger regional banks than it is with some of the money center banks that have trading and other aspects and investment banking that can really smooth out earnings. Regionals are more cyclical, and you kind of have a better read through as to the demand for money and the demand from consumers, also small businesses as well.
It's interesting today, too. We heard some commentary from leadership at some of the money center banks talking about the exuberance in AI. Citigroup CFO Mark Mason was saying some sectors are likely frothy and overvalued. And David Solomon, the CEO of Goldman Sachs, alluded to the dot-com bubble. How is your shop viewing the AI trade right now?
We feel like there's a while to go before we can really put it up against what happened in the late 90s. We don't think that that's impossible. But right now, when we're on the cycle, we feel like some of the stories of some of the pickaxes and shovels of this new gold era of AI investing. That investing is real. It's hitting the top line and bottom line of some of these corporations. They're able to transfer that into cash flow. We feel like on the front end of that investment phase is real and is hitting the ground right now. But as far as what the market's pricing in going forward, we really are conscious of how the exuberance and the behavioral mechanisms of market participants, particularly since our environment now is a little more retail oriented as far as the day-to-day trading, how that can get out of hand very quickly and almost have a circular logic as to the justification of valuations is the hype, and the hype justifies the valuations, and that leads to a phase of investing and sentiment that we feel like is not quite where we are right now, but we're really conscious of the concentration of hype and valuation and market cap in those names that could potentially lead in that direction if there's ever a hiccup in the investment or ever a doubt, as we saw a couple of years ago, about how quickly those investments can really turn to cash flow for some of these corporations.
It's interesting that you make the point about the retail crowd, because today in the U.S., the S&P 500 was in the red for less than 30 minutes, and it really points to this idea that retail continued to buy the dip. Citigroup was saying today that retail investor trading volume increased to an all-time high, defying a typically weak October when you look at things seasonally. And I'm wondering whether or not this speaks to some type of inherent risk in the overall market when you have that type of retail psychology taking hold.
Yes, and that's one of the things that we feel like is more akin to what we saw in the 90s, is just how pervasive it's become, as well as the flow into ETFs and how those trade on a day-to-day basis also really causes a lot of changing dynamics as to what really drives day-to-day movements as far as technicals and sentiment as well. So we think that's a fascinating part of how the market is evolving right now. And we don't think it's necessarily something that will shift back in any violent way. So we want to make sure we get our arms around how the market perceives those changes, as well as how our clients can benefit, frankly, from some of those shifts in how markets move because of what we feel like is driving markets, rather than the institutional space really doing that is more in the retail space, and that's almost inevitable at this point.
Keith, I'd like to get your take on this debasement trade. We have both gold and silver trading at record levels here. Are you participating in this at all? How do you view this?
Sure, we have our clients with positions in silver and gold, and we've come at it from a few different angles. It captures a lot of risk that we felt like were clear and present more than a year ago. So we've been there for a while now. We had, before it was coined debasement trade, and what we're looking at now is and we're short underweight fixed income as well, kind of in that same theme of the budget situation, not only here in the U.S. but globally, causes a lot of concern on our part. But also we're looking at safe havens that aren't typical of this type of cycle. As again, we've seen things shift from how the consumers, retail crowd is involved in market conditions, as well as just how sovereign governments have started to grapple with some of the concerns that we are grappling with here as global investors. So we've participated there, and we feel like that's a place that we want to continue being. We've trimmed some very recently in gold, but we still feel like that offers a good risk reward, even at these levels, for our clients' portfolios.
So we have a Fed meeting around the corner. Market is expecting right now, I think, a 25 basis point rate cut. A lot of concern about the weakness in the labor market. A couple of Fed officials have really spoken to that quite succinctly. And there are maybe some questions around the strength of the American consumer. I know that's a big kind of category, and there are different segments along that spectrum. But today I was struck by the fact that Edmunds.com reported the level of underwater car loans now at a 4-year high. So just over 28% of trade-ins toward the purchase of a new vehicle carried negative equity. Are you concerned about the strength of the American consumer?
We're absolutely laser focused on the strength or lack thereof in different parts of the spectrum of the consumer experience as well. The higher income earners have obviously driven spending more high proportion they have in recent history, as well as the lower end of the consumer has weathered a lot more layoffs in this economic phase that we're in, whether it's AI driven or just more productivity on the part of corporations as well. So we feel like if that gap is widening in a way that's concerning us as far as the balance of spending and therefore an inherent risk of a downturn in markets affecting that spending more so than it has in the past. We feel like that correlation or relationship between those two shouldn't be discounted because of just how much of the earnings and the stock returns can benefit those with those portfolios that they can spend from, and those that don't have those means, those more blue collar wage earners don't have that luxury. So we're really concerned with just how that really manifests itself, given the labor environment that we feel like is starting to soften in different areas of our marketplace, as well as a stock market that's trading at valuations that are historically high. So that those two ends of that conversation, cause some risk in our opinion of where the market can go from here.
Keith, before I let you go, I want to get your view on the government shutdown. We are now at day 15. Today, a federal judge in California paused what the administration was attempting to do in terms of the layoff of federal workers. To what extent is this noise, or do you think it represents something that the market really needs to be focused on, maybe a little bit more than it is?
Well, the most immediate impacts that we see are, of course, the spending that stopped, whether it's not only direct payments to those employees that earn a wage, but also the those ancillary businesses that are dependent on that spending from those consultants and lobbyists and those employees as well. So that's the most direct, very real-time impact that's undeniable, and that will come. We feel like will come through the data as being somewhat looked through and somewhat transitory, if I can use that word. But as we go forward, how much more often will these happen? I think the political environment of less collaboration and cooperation on Capitol Hill poses a risk that things just don't get done in a way that appeases what the market demands of the largest economy and the government that controls the largest economy in the world. So that's one of the larger concerns for us is just what does this mean? We're going from a nation and from Capitol Hill as far as being able to get things done in a way that we can rest easy, and that those decisions will be made in a way that investors can invest with clear conscience of the more of the animal spirits driving those valuations and those landscape of investing, rather than the puts and takes of each political week to week.
Okay, Keith, we'll leave it there. Thank you so much. Keith Buchanan, he is Senior Portfolio Manager at Globalt, joining from Atlanta, Georgia, here on the Daybreak Asia podcast. Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia-Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.